core, of course, prime assets located, in the case of Spain, in CBD, Madrid or Barcelona. But the radar is, the market has shrunk dramatically, and so has the radar of investors and lenders. So I guess that they would look for good locations and prime assets, trophy assets.
Is that what you're seeing, Jan Evert, as well? Are you seeing that it's mainly, that they're mainly in that space where you're also seeking to lend in the prime areas?
Yes and no. I think the simple and the easy answer is yes, but I've seen in transactions that we syndicated that the likes of these new entrants also participated on, I would not call it prime assets. They like the structure, they understand the real estate risks, they understand what they're going into. So there's also a no there, and that gives me an optimistic view on their contribution. Clearly everyone is chasing the same type of deal, but I think there are also, and specifically insurers out there that recognize a higher return on non-prime or not per se prime assets.
Okay. Yeah. Christian, yeah.
Maybe to add something, and again, I will completely agree, so it means that we are on the banking side. I'm becoming one. I think it's completely different when you invest in as an equity investor in real estate, and if you invest as a lender in real estate, your approach will not be the same. And as far as lending is concerned, what you will look at is the risk of losing your part of what you have put at work, part of what you have part of what you have lent. And if you think about it, most of the investors in equity today will invest in prime because they will look at real estate as a way to preserve their capital, and they will say that even if it is expensive, the risk of losing 5 to 10% to 15% is very limited. When it comes to financing, the approach is very different. And again, when we are talking about senior financing, we are talking about LTVs of roughly 50 to 60%. And then the logic is different because before you start losing money, the underlying value of the asset has to drop by 40 to 50%, which allows much more things to finance than pure equity investment. So I agree with you. I think the approach is much wider, and we are today looking at much more things than what we do as an equity investor for core investors, core real estate investors.
Sorry, yes.
No, just one thing that I would like to say as a lawyer, as a legal advisor, is that Solvency II, the same as Basel III, but in this particular case, Solvency II, and the different regulations in the different jurisdictions are the starting point, in my view, of a trend, no doubt. This is a trend which in Spain, for instance, has been followed by the newly regulations passed by Bank of Spain recently. And the result of this trend, from a legal point of view and an accounting point of view as well, is that for many institutions, for many banks, insurance companies, and so on, for many institutions holding properties, real estate assets directly on their balance sheet, will be a killer for their core capital. And this is a regulatory thing, of course. This is legal stuff, but it's a driver for the market.
Good, thank you. Yeah.
Just one addition there. If you again talk about insurance companies, it's very difficult to say prime or non-prime. You have to look at the insurance companies. Firstly, are they only investing on their own account, or are they investing on account of policy holders? If it's also on account of policy holders, they may go beyond prime. Secondly, you also have to look if they invest in funds or not. So are they also an asset manager? So just looking at insurance companies and are they investing prime or not, you have to see what is the source where they finance for. And finally, just a connecting point with the comment you made about loan originating platform. Even if insurance companies go in prime only, it's probably not only because of the risk aversion, but also because of the loan originating platform. Just going into prime, maybe in partnership with a bank, is a totally different ballgame than basically lending on a secondary market. They just don't, at least And respectfully, I say so. You can't compare them all, but they don't have that platform to go beyond prime. So there's a lot of basically different angles here.